Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of what you need to know about commodity futures trading in 2024. Curious about the buzz surrounding commodity futures? You're not alone. These financial instruments are crucial for investors looking to hedge against market volatility or speculate on price movements. But what exactly are they and why do they matter? This blog video dives into their role in shaping the economy and influencing prices for everything from oil to coffee. Get ready to uncover how traders and companies use these contracts to navigate risks and seize opportunities in the intricate dance of supply and demand. Whether you're a seasoned investor or just starting out, understanding commodity futures can open up new avenues for smart financial decisions. What are commodity futures? Commodity futures are a fascinating part of the financial market. Think of them as agreements or promises between two parties. These deals are made today but fulfilled in the future. They're used to buy or sell specific quantities of a commodity at a predetermined price. Let's break it down further to understand them better. Definition and basics. Commodity futures can sound complicated, but they're really about planning and security. A futures contract is an agreement to buy or sell a commodity at a future date. This allows traders to lock in prices in advance. The underlying asset refers to the actual item being traded, like oil, wheat or gold. These contracts have an expiration date, which is the last day the contract is valid. After this date, the trade must be settled, either by delivering the commodity or by a cash settlement. Now, how do they differ from other financial instruments? Unlike stocks, where you own a piece of a company with futures, you're just agreeing to make a trade in the future. This is a powerful way for businesses to manage risk, but it also comes with its own risks and benefits. Types of commodities. Commodities are often split into two categories, hard and soft. This helps traders know what kinds of goods they're dealing with. Hard commodities are natural resources that are mined or extracted. They usually include metals, gold, silver, copper, energy, crude oil, natural gas. Soft commodities come from agricultural or livestock products. These are grown or raised, including agricultural, wheat, corn, coffee beans. Livestock, cattle, pork bellies. Understanding these categories is like knowing the ingredients for a recipe. It helps you see what makes up this part of the financial market. Each commodity brings unique challenges and opportunities, much like the weather impacts a farmer's harvest. Does this all sound a bit like a game of chess? You have to think several moves ahead, predicting how markets might change. By using commodity futures, traders and companies aim to avoid surprises and ensure their financial moves are strategic. How commodity futures work. Commodity futures might sound complex, but they're really just about planning ahead. Imagine you're setting the date for a big event. Only here, you're agreeing to buy or sell goods at a future time and price. This system provides stability in a world that's anything but predictable. Let's dive into how it all fits together. Futures contracts and exchanges. Futures contracts are the heart of commodity trading. They allow traders to agree on a price for a specific amount of a commodity to be delivered at a set date. Think of it as making a reservation for a hotel room months in advance. You lock in the rate now, regardless of future price changes. These contracts are traded on major exchanges like the Chicago Mercantile Exchange, CME, and the Intercontinental Exchange, ICE. Think of these exchanges as bustling marketplaces where traders from all over the world come together. The CME, for example, is a giant bazaar for everything from agricultural products like wheat and corn to metals and energy. CME Group, the world's largest financial exchange, catering to a wide range of commodities. ICE focuses on energy and soft commodities, offering global market access. These exchanges aren't just meeting places. They ensure fair trading by setting rules and monitoring transactions. Margin and leverage. Margin and leverage can be a trader's best friend or worst enemy. Here's where things get a bit thrilling. Traders don't need the full contract value to trade. Instead, they put down a small deposit called the margin. Margin is like a down payment on a house. It's your skin in the game. Leverage refers to using this margin to control a larger contract size. If used wisely, leverage can amplify returns, but it can also magnify losses. Initial margin, the upfront cost to open a position, usually a small percentage of the total contract value. Maintenance margin, the minimum account balance to keep a trade open. If your balance falls below this, you'll face a margin call, much like getting notified when your bank balance is too low. To visualize, if a contract is worth $100,000, you might only need $5,000 as margin, allowing you to control a large position with little upfront cost. However, just as with borrowing money, missteps can lead to significant debt. This makes risk management crucial, kind of like having a GPS for safe navigation through these trading waters. Understanding these fundamentals builds a foundation for exploring more sophisticated strategies. As you learn, always remember that the key is balancing opportunity with risk. Benefits of trading commodity futures. Commodity futures trading offers numerous benefits for both seasoned and new investors. The allure of trading these contracts stems from their potential to increase your financial flexibility and provide you with peace of mind during uncertain times. Let's explore how these financial instruments can come in handy for hedging price fluctuations and diversifying your investment portfolio. Hedging against price fluctuations. Have you ever imagined insurance against sudden price swings in the market? That's exactly what commodity futures can offer. Imagine you are a farmer growing corn. You know that the market price for corn can change drastically due to unpredictable weather or supply chain disruptions. By entering into a futures contract, you can lock in a price for your produce. This way, even if the market price drops at harvest time, you're not losing out. It's a safety net that protects you from financial shocks. For businesses that rely heavily on raw materials, like airlines needing jet fuel, futures act as a shield against wild price changes. This predictability lets them plan their budgets and operations more confidently. Portfolio diversification. Who doesn't want a well-rounded investment portfolio? Commodity futures can play a vital role in achieving this. Picture your investments like a well-balanced diet. You wouldn't eat only fruits, would you? Similarly, focusing solely on stocks or bonds could leave you vulnerable to the same economic risks. Here's why adding commodity futures can be a smart move. Different market movement. Commodity prices often move independently of stocks and bonds. This means they might go up even when traditional markets go down. Risk reduction. By having a variety of asset types, including commodities, you spread out your risk. This could reduce potential losses during tough economic times. Inflation. Hedge. Commodities are things like oil, metals and grains, which tend to increase in value as inflation goes up. By investing in them, you may protect your money from losing value. Incorporating commodity futures into your investment strategy can make your portfolio as diverse and resilient as a team of superheroes. Diversification doesn't just mean more assets, it means smarter choices that work together toward a common goal, growing your wealth and reducing risk. So why not consider adding this powerful tool to your investment toolbox? Risks involved in commodity futures trading. Commodity futures trading isn't for the faint-hearted. It offers a chance to make significant profits, but it also comes with a fair share of risks. Understanding these risks can help traders make better decisions and potentially shield themselves from significant losses. Let's break down two major risks in this area. Market volatility. When it comes to commodity futures, market volatility is a double-edged sword. Commodities like oil, gold and wheat can swing wildly in price due to various factors such as weather conditions. A drought or flood can drastically change the supply of agricultural products. Political events. Unrest in oil-producing regions can send prices soaring. Economic trends. A booming economy might boost demand for raw materials. These price shifts can create opportunities for profit, but they can also lead to significant losses if the market moves against the trader's position. Imagine riding a roller coaster blindfolded. Exciting, but also a bit terrifying. Leverage risks. Leverage allows traders to control large positions with a relatively small amount of capital. While this can amplify gains, it can also magnify losses. Here's why. Increased exposure. With leverage, a small price change in the underlying commodity can lead to large financial swings. Margin calls. If the market moves unfavorably, traders might need to deposit additional funds to maintain their position, known as a margin call. Potential for full loss. In extreme cases, traders not only lose their initial investment, but might also owe more than they invested. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.